And we're live. Hi, everybody, and welcome to today's webinar on Bitcoin on the balance sheet, institutional treasury strategy in place. I'll give everybody just a few seconds to adjust, and then we will get started. All right. Let's begin. Welcome again. My name is Giorgia Pellizzari. I'm Managing Director and Head of Custody at Hex Trust. And today I will be moderating this very timely and relevant panel. Quickly about Hex Trust, we're a leading provider in institutional digital asset services. We support clients globally. We license custody, staking, market services, investment solutions, and tokenization infrastructure with licensees across the globe, from Hong Kong, Singapore, Dubai, and Italy. As more listed company and digital asset treasury integrate digital asset into their strategies, Hex Trust provides secure infrastructure and expertise that institutions need to execute at scale. Now, moving on to today's topic. Across global markets, we're seeing a growing shift in our corporates view crypto. It's no longer just about hedging against inflation or currency risk. It's becoming more of an integral part of treasury and capital market strategy. From listed companies embedding Bitcoin into the balance sheet to traditional corporates exploring diversification and yield generation, this evolution is really reshaping financial positioning on a global scale. Today, with our great group of panelists, we're going to be exploring what's driving this momentum, why this momentum is now, the strategic frameworks that companies are building and executing on, and how they're navigating governance, regulation, and market opportunities in a very fast-moving industry. Now, let's meet our panelists. We're joined by four outstanding leaders across the industry. Let's start with Norma Chu, founder, chairwoman, and CEO of DDC Enterprise. Norma leads a global food platform and one of the top corporate Bitcoin treasuries worldwide. She's also one of the few Asian female founders of an NYSE-listed company, applying a first principle approach to risk management, long-term value creation, and shareholder alignment. Welcome, Norma.
Thanks for having me here, Georgia.
Absolutely. Now, moving on to Karen Tseng. Karen is Chief Strategy Officer at Moon Inc. A CFA charter holder with over a decade in experience in private equity, public markets, Karen now drives Bitcoin treasury strategy and Web3 expansion for this Hong Kong-listed company following the acquisition in 2025. Welcome, Karen. Thanks for being here.
Hi, Julia.
Giselle Lai, Associate Investment Director, Digital Asset, Fidelity Institutional. Giselle supports Fidelity's global digital asset strategies with deep expertise in fixed income and alternative investments. She's also an active advocate for education and diversity in Web3. Welcome, Giselle.
Thank you, Georgia. Thank you for having me.
Last but not least, dear colleague and head of OTC at Hex Trust, Charmaine Tan. Charmaine leads institutional and high net worth trading services at Hex Trust, bringing 15 years experience from Goldman Sachs, Credit Suisse, and Ashke Exchange. Thank you for being with us, Charmaine, today.
Thank you, Julia.
All right, now let's look at the agenda for today. This is how we're going to be structuring the discussion. The core of the event is a panel discussion, of course, with our panelists. We're going to be exploring how crypto treasury strategies have evolved, why companies are moving now into this, the ETF trade-off, what institutional investors are looking for, and how corporates are moving from allocation of crypto to activation. Following the panel discussion, we're going to be having 10 to 15 minutes Q&A for questions from the audience. A couple of quick housekeeping notes. This session is being recorded, so you'll be receiving a copy of the recording after the event. We encourage interaction, so please submit your questions, and we're going to be going through them at the end of the panel discussion during Q&A. And last but not least, very importantly, as always, today's discussion is for informational purposes only and should not be taken as financial, investment, or legal advice in any jurisdiction. Great. Now let's move on to the panel. First topic is crypto treasury models and how they have evolved from hedge to strategy. Norma, let's start with you. Norma, DDC Enterprise is positioning itself as one of the top corporate Bitcoin treasuries globally. Can you walk us through how you evolved from viewing Bitcoin as an edge to making it a core part of your broader corporate strategy?
Yeah, sure, absolutely. I think first of all, as a business owner, we view Bitcoin as the best hedge against, inflation, currency volatility, and uncertain macroeconomic conditions. Three unique Bitcoin attributes really caught my attention. Scarcity, decentralization, and also independence from traditional monetary policy. So it is, I think, the most effective shield, in a world where fiat money is increasingly prone to inflationary pressure. But then as I started, doing more research and really increasing my conviction in Bitcoin, what we realized is Bitcoin could serve so much more than just a defensive role. What we've done is we've launched a Bitcoin, very aggressive Bitcoin accumulation plan, alongside with an unprecedented capital raise of $528 million US from prominent institutional investors like Animoca Brands, Anson Funds, and Kinetic Capital. This raise we just completed last month in July. Those completely dedicated exclusively for accumulating Bitcoin. So now that we have the capital in place, we've been focused on executing several high-impact Bitcoin purchases. In July alone, we acquired 230 Bitcoin, and this month so far in August, we continue to buy about 220 Bitcoins. Right now, our average cost of our treasury is roughly 100,000 Bitcoin per 100,000 US dollar per Bitcoin, with BTC yield improvement exceeding 1,000% compared to our initial purchase back in May. So, first you get access to funding, and then we started stacking. But really, aside from stacking, we also recognize that building one of the world's top Bitcoin corporate treasuries, it requires more than just accumulation, right? It's really it involves custody, trading efficiency, and also yield enhancement. So to that end, in the past month or so, we've really been forging a lot of critical infrastructure partnerships with market leaders such as Hex Trust, QCP Capital, Galaxy Digital, and these partnerships really will enable us to move beyond just passive holding, but actively also generating institutional grade yield through derivatives and also regulated strategies. So, our mission is very clear. We want to become one of the top 3 global public Bitcoin treasury companies within 3 years. So definitely a very aggressive target. But at the same time, we also believe it's very achievable. This vision integrates Bitcoin into our corporate DNA, balancing it alongside, our core food business to create a diversified and resilient enterprise to come for decades ahead of us.
Thank you, Norma. First of all, congratulations on the raise. Secondly, I think it was very insightful to hear that executing on a Bitcoin strategy is a lot more than just buying and holding Bitcoin. You really share like all the work and network partnership that is behind it. Now, a follow-up question is how do you manage risk, right? Bitcoin is also synonym for some with risk. So how do you balance that as part of your strategy?
Yeah, balancing risk management while integrating Bitcoin as a treasury asset for a listed company definitely requires a lot of a thoughtful and multi-layer approach. And we really think about risk management in the following 4 ways, right? Number 1, I think, is about our mindset and how we treat Bitcoin as a long-term strategic asset, rather than thinking it as a speculative short-term investment, right? So if we position it as a strategic store of value and part of a diversified treasury reserve, similar to how other companies might hold gold or cash equivalents, you having this long-term perspective really help us absorb near-term Bitcoin price fluctuations without reacting impulsively. So I think mindset and how we view this asset is very important. Second layer is really having a robust governance and risk oversight. So we have designed and implemented, governance and also risk oversight mechanisms to regularly review our exposure limits, understanding market conditions and regulatory landscape to adjust our framework accordingly. Right now we have risk limits that ensure the Bitcoin holdings increase at an aggressive but also disciplined pace. Where we're really watching our leverage ratios closely. It's just so that in any kind of bear market scenarios, we would not have to be put in a position where we're forced to sell our Bitcoin. Third layer is really thinking about positioning ourselves well enough with capital structure and access to liquidity. So for example, the $528 million raise back in July, it really includes a number of different financing tools that we have now at DDC. We have a PIPE, we had an equity line of credit, and also convertible notes. It provides a lot of liquidity that enable us to immediately start and stacking and consistently stack over time. At the same time, we have a lot of financial flexibility with these different kind of products. I think having a strong liquidity buffer means that, once again, we don't find ourselves in a position where we have to be forced to sell a Bitcoin in inopportune time, right, to meet any kind of funding needs. And finally, I think, when we think about risk management, it's also about having a transparent communication with our, stakeholders, partners, and then also about investor education. And so managing market perception and also communication is also very important for our overall strategy. We're committed to transparent and consistent disclosure about Bitcoin valuation on our balance sheet. We recently launched, a dashboard on our website that basically tracks almost real-time movement in our treasury. We believe, clear communication builds investor understanding in terms of our strategy, what we're trying to achieve in the short, medium, and long term. And so, combining a long-term strategic mindset, having governance oversight, making sure that the company has liquidity management and also ongoing investor communication is how we holistically think about risk management at DDC.
Fantastic. Thank you, Norma. Now, Karen, moving on to you. Moon Inc., what a significant transformation following the acquisition and really the move onto Bitcoin Treasury management. Can you talk a little bit about what was the tipping point for embedding Bitcoin into your capital market strategy?
Yeah, I don't think there's any particular tipping point. It was really about long-term resilience. So back in December, we approached this Hong Kong listed company that it had strong cash flows, solid balance sheet, and very good foundation. However, we see the limited growth due to its traditional structure. If this company can diversify its product by integrating itself with Web 3.0, attracts capital, and actively manage its treasury, I think its full potential can be unlocked. So me and my partners saw this huge opportunity, and we just went for it and acquired the company. It was a really quick decision.
Okay, so
Yeah.
that's aggressive and to the point. Very good. Then let's talk a little bit about investor alignment, right? How do you align these treasury decisions, right, with investor expectations, especially considering that we're talking about a Hong Kong Stock Exchange listed company?
Yeah, so we are taking a much longer term view in our business strategy, and we're integrating our products with Web 3.0. We're diversifying our treasury from pure fiat to Bitcoin, earning Bitcoin yields, and also the appreciation of Bitcoin value, and allowing investors and our shareholders to participate in this and ride on our transformation. Our long-term goal would be getting into the Hong Kong Connect and let the Chinese investors capture on this growth as well. And also riding on the evolving landscape of digital assets and the crypto development in Hong Kong. I think all the above is in the long-term interest of our company as a whole and of the shareholders. And we are probably one of the most transparent Hong Kong listed companies that tells our shareholders exactly what we are doing with this company and how we are doing it, and where are we looking at our company in the long term. And we believe that 1723 is unique and revolutionary in the Bitcoin industry.
Thank you, Karen. I like to see that the transparency pops up very often, and I think this is kind of beautifully in line with what blockchain stands for, being transparent, being out there. So I think that's really great. Moving on to the next section of the event, we're going to be talking now about why this is the time. So why now? Giselle, moving on to you, from Fidelity's perspective, what shifts in the market sentiment and regulatory clarity have you observed this year that, in your opinion, are prompting more institutions to consider this type of, alternative allocations?
Thank you, Georgia. One of the shifts was definitely the regulatory clarity.
Giselle, we cannot hear you very well, unfortunately.
All right now.
No, you're breaking up quite a bit.
Oh, can you hear me?
Same. I think maybe, Giselle, while you perhaps try to reconnect, I'm going to move on to the next question, which is actually for Norma while we wait for Giselle. So Norma, from your position as a corporate leader, what developments have you, in your opinion, have given you the greater confidence that this is the time to scale your Bitcoin treasury in comparison to previous years?
Yeah, I mean, that's a great question. I get asked, why now, a lot by investors. And I think from my perspective as a corporate leader, the most significant development giving me greater confidence in scaling our Bitcoin strategy in 2025 compared to any previous years is really the remarkable progress that we've seen in the regulatory clarity around Bitcoin and digital assets. I mean, for so many years, the uncertainty around Bitcoin and other digital assets, how they are going to be regulated has really kept so many investors on the sideline, right? Let alone corporate treasurers. However, in 2024 and this year, I mean, we saw really critical milestones that transformed the landscape from high uncertainty into one that's increasingly visible and, I would say stable and manageable, right? So for example, the SEC's approval of spot Bitcoin ETFs last year really marked a watershed moment. Having these ETFs really led by major players like BlackRock provided regulatory validation that, Bitcoin is a legitimate asset class for institutional investors, right? So this not only opened a floodgate of capital from institutional investors, but also gave, corporate leaders like myself a lot of confidence that holding Bitcoin is, in line with evolving regulatory framework. Secondly, the U.S. Treasury and also other federal agencies have really started issuing very clear guidance around digital assets, custody, accounting, and also reporting requirements. So, in early 2025, executive orders and, federal working groups really focused on establishing frameworks for digital assets oversight, signaling a very serious commitment of integrating digital assets into traditional financial system, right? And so I think that's also a really important development for us to even consider holding Bitcoin on our balance sheet as a U.S. listed company. And I think finally, legislative proposals targeting stablecoin regulation and also digital asset transparency have really laid the groundwork for consistent federal rules, which reduces, legal ambiguity for corporate Bitcoin treasury activities. The regulatory momentum really means companies can now plan treasury strategies without fearing, there's going to be sudden prohibitions or, retroactive penalties. So I think all these are, really the key foundational changes and really significant shifts in the landscape that really help, I would say, founders and CEOs like myself to seriously not just considering Bitcoin as part of a treasury, but really acting on it.
Thank you, Norma. Absolutely. And maybe Karen, I'd like to ask sort of the same question, but with a narrower focus on Hong Kong. What do you think has changed here in Hong Kong to really encourage you or in general others to consider Bitcoin as a corporate strategy?
Yeah, so we all know that Hong Kong has been a pioneer in Web3 development in Asia. It was the first major Asian financial hub to launch spot Bitcoin and Ethereum ETFs in April 2024. And SFC has implemented a licensing framework for virtual asset trading platforms in June 2024. And it had just implemented the regulator regime for stablecoin issuers under stablecoin ordinance on August 1st this year. With more and more guidance and regulations on the acquisition, custodian, and exchanges, I think Hong Kong regulator environments has made Bitcoin and other digital assets more available and acceptable by an increasing number of Hong Kong listed companies. And there's one more thing I want to add is so we signed the SPA on the 14th of January, and we had a hard deadline which we wanted to rush into making the announcement on January 20th, the day of Trump's inauguration, right? So we worked so hard, and finally we published the announcement at 10:48 p.m. on the day on January 20th Hong Kong time, which is 12 minutes before 12 p.m. New York time, Trump's inauguration. So you know how Trump's administration was so pro Bitcoin, so we really want to ride on this right now. And for us, 1723, we can now participate in Bitcoin Treasury management with a clear legal framework. And our investors have greater confidence that our operations are compliant, transparent, and aligning with our shareholders' interest. I think it's really the perfect timing for us to jump in.
Yeah, that really resonates, make a lot of sense. Overall, obviously, regulatory framework is what makes, when it's not there, it really brings a lack of confidence. But when things start tipping over, and more and more regulations start welcoming all across the board in digital assets, stablecoin to RWAs, or again exchange activity, that really gives everybody confidence to push the boundaries and move things forward. So absolutely. We don't have Giselle with us yet. She's not. Oh, maybe she's back. Let's give her a moment. Hey, Giselle.
Hi, Georgia. Can you hear me all right?
Yes, we can. Welcome back.
Yeah, thank you for having me.
Of course. Okay, let's then hear it from you, Giselle. We really wanted to ask from Fidelity's perspective, what kind of shifts in market sentiment and regulations you have observed that, in your opinion, are prompting institutions to adopt crypto?
Yeah, absolutely. So yeah, one of the biggest shift obviously we've seen is regulatory clarity. That's something a lot of institutions care about deeply before they even think about allocating to a new asset class. A major turning point would be the approval of the US Bitcoin ETF last year. And I think that moves basically allows more simpler accessibility for investors in a large market. And since then, we have seen a kind of domino effect globally. We have Thailand and Taiwan open up access for professional investors for foreign crypto ETFs. Hong Kong and Australia, they launched their own local domicile crypto ETFs. And more recently, UK FCA also announced that they will lift the ban on retail access for the crypto ETFs listed on the London Stock Exchange. So I think all of these kind of upgrades and updates actually provides greater confidence and further legitimize for crypto assets as an asset class. And at the same time, we are seeing very strong and sustainable inflows into the US crypto spot ETPs. For example, these ETFs have gathered over 180 billion of assets so far, with more about 28 billion of the net inflows year to date. So this shows there's a clear demand from investors to gain exposure, particularly in Bitcoin. And when we analyze these, the holders of these ETFs, there's clearly a growing trend of institutional adoption, particularly from the strong growth of financial advisor segments, so who either want to meet their end client demands or part of their long-term strategies. And I would say we also kind of see a change in terms of the market narratives on Bitcoin, with something as a tech on steroid before, now kind of moving towards a gold on steroid, especially looking at how Bitcoin has behaved in this market cycle so far. For example, we see kind of Bitcoin kind of holds the line during the market volatility in April during Liberation Day, and volatility has also kind of trend down gradually compared to past cycles. So with all that said, now Bitcoin being a 2.4 trillion market cap, surpassing silver as an asset class, is kind of becoming harder for investors to really ignore it.
Yeah, I love this last line. Has become impossible to ignore. That's really good. Okay, Giselle, we'll stay with you as we move on to our next section, which is what we call the ETF trade-off. So from an institutional investment perspective, what are the trade-offs, in your opinion, between direct Bitcoin holdings within a corporate treasury or using a Bitcoin ETF?
Yep. So yeah, different approach come with their own trade-offs. Let's start with ETFs. So ETFs is obviously a simple, familiar tools for a lot of investors because they can basically access through a regular brokerage account, just like buying a stock. So investors don't need to really worry about all the technology nuances from setting up a wallets, how to manage private keys, so on and so forth. They obviously also come with regulatory oversight, and in some countries, potentially tax advantages. Some Bitcoin ETFs also enable in-kind redemption, which I think could be quite relevant for large institutions who may want to get exposure now, but aren't ready to build the infrastructure yet. So this kind of mechanism allows investors to redeem Bitcoin directly with the ETF units, making ETFs a potential bridge between the traditional markets and the direct crypto exposure. That said, ETFs do come with their own limitations. For example, investors can only trade them during the kind of stock market hours, and investors don't really directly own the underlying Bitcoin. On the other hand, direct investments give investors full ownership and also allows investors to trade 24/7 anytime they want. So this may be more suitable for investors who want to interact more closely with the underlying technology. That said, direct exposure also comes with added layer of complexity for institutions. For example, they do need to equip with proper infrastructure, looking for the right custody solutions, how they can manage their wallets, whether they have implemented a strong governance framework with risk controls. So just in short, for simplicity and convenience, ETFs could be a great entry point for institutions, but for institutions who want greater control or access, direct holding could be more suitable.
Thank you, Giselle. That's actually a very good comparison and very, very clear on the trade-offs between the one sort of approach to the other. And I've just realized there was actually also a question for Charmaine on the previous section. So let me get to it on the why now, right? Charmaine, given your vantage point in the OTC trading side, are you seeing a noticeable shift in demand from institutional clients this year? And if yes, what do you think is driving that?
Yes, we are actually seeing a fundamental transformation in institutional demand this year. As mentioned, the buzzword has been thrown a lot just now. Mentioned several times by Giselle, Norma, and both Karen. Is regulatory and accounting clarity. So it's driving, basically shifting a narrative shift from being a speculative interest to a strategic adoption. I'm going to touch on a little bit more about kind of the regulation clarity. For example, a lot of them is actually driving from the US. For example, the SEC and CFTC oversight, passing of the landmark clarity and the Genius bills. This is actually building a framework for much broader acceptance for digital assets in traditional finance, and giving institutions the confidence to enter the space. Since we touched on ETF just now, to kind of want to give some figures on how this improved access and how this kind of help with the market maturation as well. The cumulative trading volume of the spot US ETF for Bitcoin actually has surpassed 1 trillion over the last few months already. With the BlackRock run leading the pack with over 100 billion US dollars in AUM. And this, along with the growth of institutional-grade custody solutions, enhanced OTC liquidity, and sophisticated trading infrastructure, This is basically fundamentally shifted conversation from if we should invest to how we can actually invest safely and efficiently. And we are actually providing the proof that we can provide the same level of security and service that institution clients expect from traditional finance, which is why I think from an OTC trading vantage point, we're definitely seeing kind of a seismic change in the financial landscape.
Thank you, Charmaine. Well, since we're talking about ETF, maybe we'll stay with you, right? So how does trading spot and trading ETF really differ for institutional clients when it comes to liquidity, market access, and execution flexibility?
It's very different. Although both offer exposure to the same underlying asset, the wrapper they come in has actually fundamentally changed the entire trading experience. I'm going to break it down into 4 different categories. First, liquidity. Everybody, when it comes to trading, liquidity is the first thing that you consider. Spot Bitcoin liquidity is globally fermented, but it operates on a 24/7. While ETF liquidity is centralized on traditional exchanges and is limited to trading hours. Secondly, the market access. So institutions access spot Bitcoin through crypto native exchanges and OTC desks mostly. Some do via DEXs. And how to do that, you have to set up new accounts for that one. But ETFs, on the other hand, they're traded via existing traditional brokerage accounts. So this offers a more seamless access to traditional players. Execution flexibility as well. Spot trading provides maximum flexibility for private bespoke transaction on direct custody, whereas ETF execution is pretty much limited to the kind of the standard stock market rules, providing only price exposure as well, and no physical delivery of the underlying assets. So if you want to actually own a Bitcoin, there's no physical delivery if you buy an ETF. And last but not least, it will be settlement. This is a game changer. Spot Bitcoin settlement is on-chain, is almost instant. In contrast to that, ETF settlement follows a pretty traditional financial market rules. So typically taking T+2 business days, and you're involved in the settlement of a share, not the underlying Bitcoin.
Thank you, Charmaine. This is a really great breakdown and really clear to understand. Now, Norma, back to you. As someone who holds Bitcoin directly as a strategy and a choice, what advantages do you see in this approach compared to ETFs? And would you even still consider ETFs in certain situations?
Yeah, I think Giselle summarized the benefits of holding Bitcoin versus directly versus ETF very comprehensively already. I'll add to it from our perspective. The benefits of holding Bitcoin directly on a balance sheet. I think first and foremost, direct ownership gives us full control over the assets. And that's especially important for us because we do view it as a strategic treasury assets rather than just an investment. So I'll give you an example. We can use Bitcoin directly for yield generation activities if we want, which aligns with our broader corporate objectives. But if we invested in ETFs instead, we won't be able to do that. Secondly, I think direct ownership really eliminates intermediary risks. So with an ETF, once again, I think the experts already said it a few times. DDC would have been purchasing shares in the fund rather than really holding the Bitcoin. But I think this really introduced, counterparty risks, the risk that, the ETF provider or the custodian could face, operational issues, regulatory actions. So by owning Bitcoin outright, we eliminate this risk, which is really critical when Bitcoin becomes a much more significant portion of our treasury. Finally, I think really it's just cost efficiency, is a material consideration as well. ETFs charges management fees and other expenses, even though it's, at times very modest, but it adds up over time, right? And it reduces the overall investment return for us. So, direct ownership also avoids these type of recurring costs. However, I think there are scenarios where ETF might make sense for other corporates that are thinking about adopting Bitcoin onto their balance sheet. So, for example, buying ETF could provide you a very ease of access. It's a very simple process. So, if a company is just thinking about gradually building exposure to Bitcoin, I think an ETF might be a good place to start.
Thank you. So I guess in summary, we've talked about direct ownership, risk, we've talked about cost, and we talked about yield. So all very good point about opting for potentially as a strategy direct Bitcoin ownership. So thank you, Norma. Karen, over to you. So what governance and operational considerations influence your choice between direct holdings of Bitcoin and ETFs for Mooniq?
Yeah, so direct holdings of Bitcoin require optimal execution, enterprise-grade custody solutions, and internal control, high-level internal control. So we have a team of experts from the Bitcoin world. Our CEO, John Riggins, is the founding partner of UTXO Bitcoin Ecosystem Fund. Our CIO, Jesse Myers, managed a successful Bitcoin hedge fund and has deep experience and expertise in digital asset investment. David Bailey, leader in the Bitcoin industry, is guiding us on our board as a board member. And Jason Fang, the founder of Sora Venture, is leading us as our chairman. So our team ensures that we optimize our Bitcoin yields in our holdings. And to safeguard our Bitcoin holdings, we have developed and implemented a robust set of internal control procedures governing the acquisition and management of our Bitcoin holdings. So we are only directly holding Bitcoins right now. We are not planning to invest in any ETFs currently.
Thank you, Karen. So now moving on to the next section, which really is mainly focused on traditional investors and the investor side of things. So this is for you, Giselle. So when assessing potential allocations of crypto, what do you see as the primary concerns that investors, traditional investors at least, express? And what kind of governance, custody, transparency standards do institutional investors especially typically expect to have in place?
Right. When we speak to a lot of institutional investors, they often highlight three key risks. First is about the market risk. Like any investments, cryptocurrency can be very volatile and potentially come with a lot of capital loss. We tend to kind of see Bitcoin separate from other altcoins, given it's have a longer track record, it's relatively large size, and liquidity. Of course, with Bitcoin being a 2 trillion market cap of assets, the risk going to zero is far lower than the past. But many investors still want to mitigate this market risk. So many of them actually start to analyze how could Bitcoin contribute to the overall risk and return into the existing portfolio with starting with a small allocation. And I think the ongoing developments of the market structure, for example, with the expansion around options market, around using ETFs, also help some of the institutions to apply different hedging strategies and more better structure their risk management approach. The second risk that they often come around is the technology and security risks. A lot of hacks often grab a lot of headlines, and usually the real concerns is how the crypto assets are stored and assets. That's the reason why many institutions focus on custodians, look for strong security standards, how they manage their wallets with clear asset segregations. And especially when evaluating a Bitcoin ETF, for example, they will further scrutinize the track record of the issuer, the custodial safeguard, how is their sign-off process, whether there is any insurance coverage, as well as the fees and liquidity. And I think finally it will be around the regulatory risks, especially digital assets is still evolving quickly and fast-moving space, and that could create uncertainty. And for many kind of traditional investors, the rise of regulated vehicles like ETFs actually help to mitigate some of these risks, especially they offer some transparency, being professionally managed, and fits with some of the existing frameworks.
Thanks, Giselle. And maybe a follow-up question on trends within the group of institutional investors that you're observing. Do you see any particular types of profiles of investors that show greater interest in these type of allocations?
Yes, so we're definitely seeing a growing interest from clients globally over the past year across both the APAC and Europe, asking more around the Bitcoin ETF strategies. So in Asia, the demand is mainly coming from some private banks, family office, as well as digital platforms. Usually, they target younger investors. And in Europe, there are more inquiries from banks and digital platforms as well, particularly from Germany, Switzerland, and Spain. So for many of our clients, digital assets are still a first-time exploration. So for usually Bitcoin could be the entry point. So they're looking to partner with experienced asset managers like us to navigate the market trends, regulations, as well as risk management. I also observe a few notable trends from both retail and institutional perspectives. So at Fidelity International, we recently done an investor survey, and we noticed over 20% of retail investors in APAC now hold digital assets. Usually, younger investors embrace more, given they are more comfortable with the technology and digital native investments. And more on the institutional side, I think one difference compared to past cycle is the rising institutional participation in this cycle. And if we look into the holders of the existing Bitcoin ETFs in the US, there's a trend of rising institutions, as I mentioned earlier, from less than 20% to now over around 25%. Financial advisors is a faster growing segment, but at the same time, there's growing exposure from sovereign wealth fund as well. And I think interestingly, from a geographical location perspective, Asian-based investors actually also make up around 6% of exposure led by Hong Kong. So I think overall, there's growing adoption. It's going to be a slow burn process, especially for more traditional side of investors. It's still very new for them, but that means that the adoption will likely to grow over time as the understanding deepens, but regulation become more mature, and there's more secure access point for them.
Great insights. Thank you, Giselle. And now we are going to be moving towards the last part of our panel discussion, which is, we call it from allocation to activation, right? Allocation more to do with the strategy of allocating assets, to activation where actually things do happen in reality. And here I'm going to start this by sharing my perspective on the role of custody in this bigger trend of Bitcoin treasuries, right? I was really glad, first of all, to hear that across the panel discussion, the word custody came up multiple times. Custody, what is the role, especially institutional grade custody? We have heard from Charmaine, right, that one of the differences between holding directly Bitcoin and ETFs is that the assets are actually physically settled to you. So custody is really that infrastructure layer that allows you to receive your Bitcoin. So that's number one. Now, this really, in other words, we can call it wallet. That's what custody is really generating wallets. And institutional custody means that, at least at Hex Trust, we do so following institutional standards, bank grade standards. That means obviously utmost security when it comes to creation and management of private keys. On-chain segregation, this is incredibly important, which is not only implemented from a legal standpoint through terms, of course, of engagement, but also technologically. So every single wallet that we deliver to our clients is a unique dedicated wallet to our clients, separate from other clients, no commingling of assets, and also no commingling, of course, with our own assets. No rehypothecation, this is custody, of course. Also insurance, right? We offer insurance on our assets. That's, again, very, very important in the overall topic of giving confidence to all the different organizations that want to tap into digital assets, so that they can do it knowing that there are licensed, secure, and expert service providers like Hex Trust to offer this custody layer. Additionally, I think when it comes to not only Bitcoin, but the digital assets in general, custody is really that infrastructure layer that really has evolved since at least the beginning of Hex Trust 2018, from just safekeeping to actually the ability to deploy, whether it is staking or whether it is any other form of sort of delegation of assets that can happen directly from the safest possible place an institution would want to keep their digital assets in. So I think this is an integral part of taking a strategy from allocation to activation. And maybe to continue on this topic, I would like to now pass on to Charmaine to talk about corporate decisions on allocations and how OTC execution and market access strategies influence the success of a treasury position.
Sure, thank you, Georgia. So for corporate treasury, strategic execution is everything. You need the precision, protection, and performance. So when it comes to execution in any asset class, there are two main factors that you need to consider, which is liquidity and market slippages. And they're closely connected with each other. Imagine trading large volumes of Bitcoin on a public exchange can actually cause significant market slippage and drive up the average purchase price, because you will be sending market signals to the entire market, and that is directly impacting the value of your treasury position. So despite high aggregate liquidity, real usable liquidity is actually extremely fragmented, opaque, and hard to assess without special support in the crypto space. By utilizing the OTC desk, corporations can actually get direct access to deep institutional liquidity while minimizing the operational complexity and counterparty risk associated with these fragmented public markets. You guys have probably seen all the news about FTX and all the scandals. So counterparty risk and knowing who you're facing becomes extremely important when it comes to during block trading and execution in the crypto space in particular.
Thank you, Charmaine. A quick follow-up question around risk controls or liquidity planning measures that you would say are critical for activation of these strategies?
Sure. At the activation stage, critical risk controls focus on mitigating three main risks, I would say, and has been kind of mentioned throughout the panel as well by Noma, Giselle, and Karen. There's the operational, price, and counterparty risk. So executing through a trusted and regulated execution partner will significantly reduce the risk. And why I'm saying this, for example, imagine leveraging the OTC desk trading expertise to prioritize liquidity, pricing, and speed of execution. This will help you minimize market impact and achieve best execution through employing a different range of strategies and algos. That is typically already very commonly used in the traditional finance space. And by employing that into the crypto space, we're able to achieve the best execution out of that. And effective liquidity planning is centered on a strategic staggered approach. This involves a dollar cost averaging DCA strategy to acquire the asset over time. You won't be bulk buying and just lifting the market price in one bulk. And this is basically preventing the risk of buying at a price peak. You don't want to buy at high, sell at low. This is the worst strategy ever. So a DCA strategy will help you accumulate over a prolonged period of time and try to will be averaging your average price in general. But in order to achieve that, it will also require having a pre-arranged contest solution, as Georgia mentioned just now, to ensure immediate and secure settlement of the assets after the trade. So in short, it's essential to pick a partner like Hex Trust, who can deliver regulated, compliant execution services built specifically for institutional Bitcoin finance.
Thanks, Charmaine. Great. And I think with this, we are 10 minutes away from the end of the webinar, and we really want to get on to questions from the audience. So let me see what we have. I think it looks like the first one is for Karen. So Karen, can you elaborate more on how Bitcoin generates reward?
Okay, I feel like it's more of a question for our CIO, but I can tell whatever I do know about, because I'm from traditional finance background. With earning Bitcoin yields, you can stake the Bitcoin, and also there are financial tools that you can use as Bitcoin as the underlying asset, like short calls or puts options where you can use to earn more yields while instead of Bitcoin just sitting at your balance sheet. And our CIO, Jesse Mayers, are an expert in that, and he'll be doing most of the Bitcoin yields earning for Munich.
Thanks, Karen. Actually, I think this year has been also very interesting. Also, a little bit last year, for having seen some protocols. These are really technical sort of I would say innovations within the Bitcoin realm that actually allow for some degree of reward generation through process such as risk taking. These are very blockchain specific terms, right? And a very different type of sort of rewards that can be earned on Bitcoin. They also call it BTC Fi, right? So it's the DeFi for Bitcoin. So it's an interesting trend. And at Hex Trust, we also have interesting integration on that front for all things BTC. So thanks, Karen. We have some more question here. I've got one for Norma. So how do you manage potential volatility in Bitcoin prices when reporting quarterly results as a listed company? That's a very good question.
That's a very deep question as well. I was looking at this. I think the objective essentially is how do we deploy a comprehensive and disciplined approach to ensure that any kind of short-term price fluctuations do not impact ultimately investor confidence or distort the underlying long-term value of the company's strategy, right? And I think it's very similar to a risk management approach. I think number one, first and foremost, once again, starting with setting the expectation and mindset for our investors, right? So communicating clearly to investors and stakeholders that Bitcoin is a strategic reserve asset and is not a speculative trading instrument for DDC. So having this framework set right up front, it really helps investor understand that any kind of volatility-driven swings in quarterly earnings or asset valuations are to be anticipated, but do not reflect changes in our overall core business or treasury philosophy. Ever since our first Bitcoin purchase in May, our emphasis has been demonstrating to the market that we've been disciplined in accumulation rather than these kind of reactive buying or selling based on price movements. Secondly, I think transparent and consistent reporting practices is very important. We maintain a very strict and transparent reporting standards, which is aligned with applicable accounting rules, which typically require marking Bitcoin assets to fair market value each quarter. This means volatility once again is reflected, but investors are given detailed disclosures and also context, such as overall Bitcoin exposure relative to total size of total assets of the company, size and timing of every acquisition that we've made, and also we will share our view on the long-term value for Bitcoin. I think by providing a very comprehensive commentary on how we view this asset's market development and execution strategy should help us mitigate the risk of investors not really understanding what we're trying to build or having these kind of knee-jerk reactions to short-term price declines or spikes during earnings announcements. So coming back once again, I think the third layer would be proactive investor relations and just ongoing having communication and education efforts with this community. We regularly engage with shareholders, investors on X, and on other channels. We have probably a lot of press releases ever since we have launched this Bitcoin strategy, and really repeatedly telling the investment community how Bitcoin fits into our broader, corporate vision, including long-term economic rationale, and also, as an inflation, resistant store of value. So overall, I think our perspective, from our perspective, managing Bitcoin volatility is really about clear communication, disciplined risk management, and also investor education.
Thanks, Norma. Maybe moving on to Karen, kind of similar question to a certain extent, but more towards how to manage, the volatility of the price. Do you have strategies in place to prepare for the next crypto winter?
Yes. So, like I said before, we focus on the long-term benefits to our shareholders. And since we use minimal leverage, so short-term price volatility in Bitcoin would not have an impact on our company's cash flow or financial stability. And also, the company that we acquired had strong cash flows and solid balance sheet. So basically, we have like two engines. Our traditional business has the ability to generate strong cash flows, and we are also expanding into other geographic areas. We already announced that we are tapping into Thailand with CP Group, and we are also tapping into the Korean markets with SK Securities. So while there's a Bitcoin winter, we will have another engine fully working and generating cash flows for us, while and wait for the spring in Bitcoin.
Thank you. Great. As we are only a few minutes away, I really wanted to go around all the speakers and sort of ask this one question to everybody. So if you had to give one piece of advice to a Hong Kong corporate considering its first crypto allocation in 2025, what would it be? Maybe let's start from Charmaine this time.
I would say I'll keep it short and sweet. So your first crypto allocation should not be seen as a trade, but more as a strategic expedition into a new digital frontier. So the single most important piece of advice is to first build your fortress, then deploy your capital, which is basically, as Norma and Karen emphasized on a few times, build a very kind of stringent and resilient structure and risk framework, and then you can go from there.
Thanks, Charmaine. Same question to Karen.
Yes. So listing rules and regulations in different jurisdictions are very different. So you really have to adjust your pace and your plans, your strategies to adapt to this local market and think long term.
Thank you. Giselle, maybe over to you. I don't know if you heard the question. I was going around with all the speakers and asking if there was one piece of advice to a Hong Kong corporate considering the first crypto allocation this year, what would that piece of advice be?
Yeah, I think it would be great to start with education and risk awareness, understanding how crypto could potentially fit into one's portfolio, the risks involved, the safeguards that need to mitigate them, especially the space is moving fast. So ongoing education learning is critical. I think at Fidelity, we are very well positioned to support our clients to navigate this space with full range of offerings from investment solutions, custody to research to really help them to navigate this space with greater confidence.
Thank you, Giselle. And Norma, last words from you.
Sure. I think before making the first allocation, for me, it's always about people. So establish a cross-functional team that really have deep, understanding of the Bitcoin and digital assets. One that can, align on risk appetite and also your company's treasury appetite objectives is probably the most important thing. And when I think about people, it's not just people in-house, that team that is, working day to day with you along the strategy, but it's also people outside of your company, right? So find the right partners that can help you execute on your strategy.
Thank you, Norma. And I think maybe the last words from me, I would say an institution looking to get into this trend and really take the first step should really reach out to partners, same as Norma just mentioned, right? Reach out to partners that are licensed, that there's a proven track record, they do have the knowledge, the expertise, multiple years of activity and present in many different jurisdictions that can really help educating and also giving that confidence and really holding by hand all across this activation phase. So of course, the same as Hex Trust would do. And with this, I think we hit the end of this event. Thanks to all of our fantastic speakers for joining and sharing their insights. I think we've all learned a lot. And thank you again. Looking forward to the next one. Thank you.
Thank you, Georgia. Thanks for having me.
Thank you.